Is there trouble ahead for individual investors? The tech sector charging ahead with the NASDAQ nearing levels not seen since the dot-com boom and bust over a decade ago. Even with today's losses, are we seeing the sector peak again, and is your portfolio at risk? We're covering your assets tonight with David Scranton, CEO of Scranton Financial Group Advisors Academy, and Randy Neumann, founder of Randy Neumann Wealth Management. David, I'll start with you. You know, we sold off on the NASDAQ a little bit today, but it's been a pretty darn good run. Is it the year 2000 all over again?
Well, I do expect another significant drop at some point. Whether it's around the corner or this momentum is going to take us farther, it's impossible to tell. What I can tell you, though, is that even if one would argue that the Dow and the S&P 500 have topped out, at the tail end of a cyclical bull market, it's typically the smaller companies, such as some of those in the NASDAQ, that continue to carry the momentum.
Well, I got to tell you, some of those companies in the NASDAQ ain't so small. Yeah. Randy, to you, it looks like when you get down and do the analysis, the NASDAQ's run lately has really been driven by just some very big names. And most of the momentum has been among those. Are you a fan of tech stocks now?
Not particularly. I think the biggest name they have is Janet Yellen, pumping money into the market. It's almost no other place to invest because you don't want to be in bonds when interest rates go up. And
So take a look at what's happened to some of the biggest companies. Apple up 2,100% since March 2000. Look at these numbers. I mean, they're astonishing. And David, to you, as you look at this, boy, we got creamed in the dot-com bust, didn't we? Should we be thinking about that again all over?
I'm not as worried about a tech bubble bursting per se, because a lot of the technology stocks now are actually making profits, whereas many of them weren't back in the year 2000. What I am worried about is more or less an overall market pullback. I mean, bottom line is we have nearly 200 years of historical evidence that says that in every secular bear market we've ever had, we usually get at least 3 or more significant drops. And in this one so far, we've only had 2 since the year 2000.
I know. A lot of people are talking about how long in the tooth this bull market has been. I want to talk about one of the big stars, or potential stars, and that's Alibaba, which is coming public possibly as early as Friday. Just breaking news moments ago that they are going to price in a range 66 to 68 bucks a share. They're raising that target. Randy, to you. Should I be trying, as an individual investor, someone who's investing for retirement, putting the kids through college, should I be trying to get a piece of this action?
No.
Why not?
Well, let's look at the macro. I mean, the stock market is one thing, and the stock market's going to have its ups and downs. So the way to alleviate that is to invest in alternative investments, get things that aren't the market, like business development corporations, like REITs, like anything that is not the market.
So that can be tough to do, but there are ways, obviously. David, to you, I'm talking about Alibaba here. Big company, Chinese internet, and the amazing thing about it is this is not like the companies that led the dot-com boom. They have earnings, they have sales, it's a real company, they have huge market share, they're the big player. Why shouldn't individual investors try to get a piece of the action?
First of all, Randy just burst my bubble. I was about to take about half of my personal net worth and buy Alibaba, but I guess now I probably shouldn't after his advice. Bottom line is this: whenever an individual investor is going to buy an IPO, it's got to be with a small part of their money, and it's got to be money they don't need for retirement or college for children or anything like that. And you know, the reality of it is there's always a trade-off. You know, when the markets are high at the end of a cyclical bull market, that's when people typically want to have an IPO, somebody like Jack Ma, because they get more money. But it could also be the worst time for the average investor, and that's always the dichotomy.
Randy, so I look at it this way. The people who make money in IPOs typically are friends of the family, right? It's the people who help bring that company public, the friends of the investment bankers, everybody who knows anybody who ever worked there. And just average Joe like me trying to ride along, it's super hard to get the same prices as those people, right?
Well, you're already priced out of some of it. There were some real deal makers in 2012 who got some preferred shares.
Right.
So when this thing hits, they're going to hit a home run. And
but we ain't those people, is my point.
Right.
Thanks, guys. You did a great job tonight. Appreciate your time. David and Randy.